Niklas, thank you so much for joining us here at Empower. We've been hearing you on a panel this morning, and on that panel there was a lot of talk about the inevitability of a recession and fairly pessimistic outlook economically that we're in. It is a very challenging environment. How on earth do you begin to strategise for such an environment?
The panel was quite gloomy, and we are not fully that gloomy at AP4, but we admit that it's a very difficult situation and a lot of uncertainty. And things goes back all the way to the great financial crisis and over the euro crisis, the pandemic, and all the very expansionary monetary policies and at times fiscal policies that have been used along the way to handle the different crises. And we have built up a lot of imbalances in the economy that need to be normalized or be sorted out over time. And I guess the hope when we come into 2022 was that should start to happen a little bit step by step, but then we got hit by this awful war on Ukraine, which really got things moving very quickly with spike in inflation, and central banks are very quickly hiking interest rates, and the fiscal policy couldn't do anything more or less, just because they will further underblow inflation. So 2022 was very problematic when you had markets with high inflation, increasing rates, and a slowing economy at the same time, which is really the worst thing for financial markets, and diversification didn't work at all during 2022. So coming from here and how we look at the portfolio, when there is in certain markets, working with the stability of a portfolio, the robustness of portfolio, and diversifying portfolio is really, really key. And we work with macroeconomic scenarios as a starting point for our strategic allocation. And as you can understand, we have a quite wide range of different outcomes going from here. From the one end, a soft landing, which can be quite positive for the markets, and on the other end, a very deep and long recession, which is of course awful for markets. And the likelihood of those scenarios and the ones in between are quite high, all of them. So we really try to diversify our portfolio and get the portfolio that are working quite well in as many of those scenarios as possible.
With all of that in mind, what are the best teams doing and what approaches are they taking? And do you have to be completely defensive, or are there people really going out on the front foot and saying, right, where do we need to move next? And are there opportunities in an environment like this? What's the best approach?
There's certain opportunities, but let's come back to how we build a robust portfolio. We are a very long-term investor as a pension fund. We have a 40-year investment horizon, and we split it up in different time horizons to diversify also on different time horizons. We diversify across asset classes and sub-asset classes, but also we diversify very much across risk factors, macro risk factors, and also diversify public, non-public, and to a large extent with also sustainability factors. So our approach now is to find a portfolio that can work fairly well, as I mentioned, in many of these scenarios, and to some extent the things that happened in 2022 are not completely. It's a tail risk, but some of the things happening was not completely a surprise to us in a way. Already back in 2017, in our macroeconomic scenarios, we were started to addressing that the rates need to normalize. We were thinking already back then that inflation, the risk for coming inflation is increasing. So we started already back in 2017 to change our portfolio and did that quite a lot.
In a way, that long period of such low interest rates was more of an anomaly.
Yeah, of course, and also with all the structural problems in the economy and all the expansionary monetary policy and fiscal policy, at some point in time could lead to inflation. So that was something we were anticipating and working with, and in order to change the portfolio for that type of outlook, we did a number of things. The most important perhaps was that we invested more into what we call real assets, or assets with long-term stable cash flows, and we lit the growth exposure. So in a way that they are work well in inflationary scenarios, and are very, very stable in the portfolio. So we switch out of nominal bonds into these type of assets, which is very much infrastructure, certain type of real estate, forest, timberland, and those type of things. So that was one thing we did to a quite large extent. Another was that we introduced a few years ago a new equity asset class that we call defensive equities, which is a tailored portfolio of equities that supposedly should work well in a more inflationary scenario and a more problematic scenario. So we did things in portfolio ahead of 2022 that was helpful for us, but of course it couldn't protect us fully from the outcome in 2022. So now we are still working on how we should balance the portfolio going forward, and we have made it more defensive still. So we have increased into defensive equities, more into real assets, and also take down the growth exposure in the portfolio. So we have a fairly balanced and fairly defensive portfolios going forward.
So within those portfolios, what are you seeing in terms of the opportunities for sustainable investments? Because obviously that's a demand that perhaps the end user is putting in place, and it's an expectation that this industry should be doing what they can. So do you think that's realistic in terms of having those perhaps defensive portfolios but still looking at the sustainability issue?
Yeah, of course. And when I talk about the more defensive type of portfolio, it doesn't mean that we don't work a lot with sustainability. We have a very long tradition in this area. Being a public pension fund with a very long-term investment horizon, sustainability is key for us. And in the long term, it definitely have an impact on risk and return on the portfolio. So we have been working with sustainability for 3 or 4 decades, I should say, and also with the climate transition for the last decade. So that is something now that is integrated in all our investment processes, and also part when we build a robust portfolio, it needs to be robust also in terms of sustainability risks. And those risks are quite often what economists call externalities. They're not priced correctly by the market, so we need to figure out and manage those risks in portfolio, because they will probably be priced at some point in time. But then of course there are opportunities there as well, and not the least in the sustainability area. There is climate transition going on that they need to be speeded up, according to me, and that will generate investment opportunities as well. So we have spent quite a lot of time the last couple of years to invest into sustainability themes that we believe can offer both good investment opportunities, as well as be very helpful in driving the transition as such, and that is speeding up with the Inflation Reduction Act and things coming in Europe. I think investments into the supply side of the energy systems will increase quite a lot, because fossil-free energy and electricity is the real engine driving the whole transition, and we need to speed up investment into those areas. And then you have other structural themes that we feel are very interesting. You have the now much very discussed artificial intelligence, AI, machine learning, and automation and digitalization. That is nothing new, but it will speed up the implementation and applications of it will speed up going forward, and that will have some problems, but mainly will drive productivity and also create a lot of good investment opportunities for us. And then you have a bit on the sad side, we have the changed geopolitical situation and the worsened security situation in the world that also drives a lot of needed changes. You have it in the value chains, in the logistical systems, you have it in defense, you have it in cybersecurity, energy systems, and so on. So there are a lot of structural needs also due to the security situation, which we also look quite a lot into to find good opportunities for us to invest into. So not everything is gloomy. There are a lot of opportunities out there as well that we try to capture.
And the private markets are mixed in there as well.
Yeah, private market is for us doesn't define an asset class. It's more an implementation thing. So we have private market investment in equities. We have it in debt, in fixed income. We have it, of course, in real estate and infrastructure, and that to some extent is a diversification in terms of valuation. As you can see last year, that the public markets was quite badly hurt, whereas the private market valuation, private market was not at all that was not taken down at all that much. that's a more long-term thing that will correct in the long term. And some of the private investment have too much leverage that can create certain problems as well. But we use the public and the non-public market, and the non-public very much to complement what we do in public market, and try to find investment that we can't find in the public market, and build a more robust portfolio in that way.
I appreciate in a pension fund it's a very long-term view you're taking, but if you wouldn't mind just sort of maybe describing to me what your shorter-term view is. Niklas, in the next 12 months, what do you expect to be prioritising and focusing on?
As I said, we feel that the outlook is very, very uncertain. I guess it's always uncertain, but it is extremely uncertain at the moment. And we have the scenarios, as I mentioned, all the way from that the central banks are able to curb down the inflation, and we have some kind of soft landing in the economy, which then would be positive for the financial market. But as likely the central banks will willingly or unwillingly force the economies into quite harsh and long recession, and that will be awful for financial markets, but also, of course, for labor markets and the economies as such. So there are widespread of uncertainties there, and they are quite high likelihood for many of them, and that's why we focus so much on building a robust portfolio. But we are a little bit on the top, defensively oriented in our allocation.
Thank you so much for sharing your thoughts, and it was great to talk to you.
Thank you.